Hey, welcome back to Compounding Quietly. Most dividend investors are chasing yield, but the largest dividend growth ETF in the world keeps attracting capital precisely because it doesn't chase yield at all. That distinction might change how you think about dividend investing entirely. Let's get into it. Here's what's interesting about the current moment in dividend investing. A lot of people are drawn to the highest yielding funds, the ones that pay out 4, 5, even 6% a year. And when the market gets choppy, that yield feels like a floor. It feels like safety. But there's a pattern worth noticing. Every time volatility picks up, money doesn't actually flow toward high-yield dividend funds. It flows toward the ones that grow their dividends consistently over time. That tells you something about how experienced investors are framing the question. The question isn't which ETF is paying me the most right now. The question is, which ETF's income stream will be meaningfully larger 5 or 10 years from now? That's a different question entirely. And it's the question that VIG, the Vanguard Dividend Appreciation ETF, was built to answer. VIG is the largest dividend growth ETF in the world by assets under management. As of early 2026, it holds over $117 billion in assets. That kind of scale doesn't accumulate by accident. It accumulates because a lot of investors, over a long period of time, decided that this structure matched their criteria, not because it was the most exciting option, because it was the most consistent one. So what does VIG actually hold, and why does the structure matter? VIG tracks the S&P U.S. Dividend Growers Index. That index has one core requirement. A company must have increased its dividend for at least 10 consecutive years to be included, not paying a high dividend, not being in a specific sector. Just has this company been consistently raising its dividend for a decade or more? That filter alone changes the composition of the fund completely. You're not looking at the highest yielding corners of the market. You're looking at companies with long, stable operating histories, companies that have survived recessions, interest rate cycles, and competitive disruptions, and still found room to increase what they return to shareholders. Think about what that actually means. If a company has raised its dividend every year for 10 or 15 years, something structural must be true about that business. It has durable revenue. It manages its capital well. Its model doesn't collapse the moment the economy slows. Investors often react to dividend cuts emotionally with fear, sometimes with regret. VIG's structure filters for companies that almost never make that cut. The fund currently holds around 334 stocks. The top 10 holdings alone represent about 32% of the total portfolio. Looking at those top names, Broadcom sits at the top at just over 4%, followed closely by Apple at 4%, Microsoft at 3.8%, JP Morgan Chase at 3.5%, and Eli Lilly at 3.5%. ExxonMobil, Johnson & Johnson, Walmart, Visa, and Costco round out the top 10. That list tells a story. Technology at nearly 24% of the portfolio, financial services at around 20%, healthcare at 17%, industrials and consumer staples filling in behind. These are not sectors chasing short-term momentum. They are sectors where businesses generate cash, reliably and predictably over long time horizons. Now, coming back to the original question, why would someone choose a fund with a current yield of around 1.5% when higher-yielding alternatives exist? The answer is in the growth rate, not the current payout. A 1.5% yield today that compounds at 8 or 10% annually will look very different in a decade. Think about an investor who held this fund through a full market cycle. They weren't excited by the dividend number at first, but year after year, quietly, that income stream kept growing, and so did the price. By the time they looked back, the total return picture had become something they hadn't quite expected when they started. That's what consistency actually looks like in practice. VIG's 5-year average annual return has been around 10.4%. Its 1-year return recently came in just over 20%. The expense ratio is 0.04%, essentially zero. The structure is passive, low cost, and built for long holding periods. If your investment criteria are patience and consistency, this fund's design aligns directly with that. Here is the judgment that matters. VIG is not a fund you hold because the market looks good right now. It's a fund you hold because your criteria are clear, and you've decided that a growing income stream, over time, is worth more to you than a high payout today. That's not a better or worse choice. It's a different one. And knowing which category you belong to before you invest is the difference between holding through volatility with calm and second-guessing your position every time the price moves. A lot of investors only figure out what kind of investor they are after they've already made the decision. The better move is to figure it out first, not after. Compounding quietly investing that gives you peace of mind. If this video helped, subscribe and leave a like. I hope this becomes a small source of strength in your investment journey. The content in this video is for general informational purposes only. All final decisions and responsibilities remain with the investor. Thank you for spending time with Compounding Quietly today.